Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Greetings. Welcome to the College Investor Audio Show. So glad you are here. So today we're talking about short selling stock. Let's get right to it. If you're trying to cash in on a hunch that a stock is going to fall, short selling may sound like a compelling option. But before you jump into this active trading strategy, it's important to understand how it works and why it's so risky. So what does shorting a stock actually mean? Short selling is a short-term stock trading strategy, tongue twister, try to say that 5 times fast, that involves making money when a stock drops in price. So this happens when an investor borrows shares of stock from another investor who owns the shares. The borrower pays a fee and agrees to return the shares on a particular date. The borrower then immediately sells the stock to another buyer. When the shares are due, or before then, the stock borrower can rebuy the shares and return them to the lender, I should say. The borrower made money if the stock price dropped during the holding period. They lost money if the stock price increased during the holding period. Let's take a look at a theoretical example. Borrower Bjorn borrows 100 shares of XYZ stock from lender Lucy. He borrows the stock at $10 per share and sells them on the open market to buyer Bob, who pays $10 per share. 3 days later, the price of XYZ has fallen to $7 per share. Borrower Bjorn buys 100 shares of XYZ from seller Scott for $7 a share. Bjorn returns the 100 shares to Lucy. In that transaction, Bjorn earned $3 per share for a profit of $300, less whatever fee he paid to Lucy, of course. Now, in this example, it's just stylized to show how stock and money flow in a short sale. In reality, Bjorn, Lucy, Bob, and Scott don't know each other's names, and all transactions happen electronically. But can't they all be friends too? So, the next question is shorting a stock risky? Well, shorting a stock has an asymmetric risk profile. It offers a good chance at a small upside and a small chance at an infinite downside. Unlike most forms of investing, short selling can leave investors with negative money. In a worst-case scenario, an investor can end up bankrupt after a bad trade. If the price of a stock falls after borrowing it, the person shorting the stock can make a profit. If a stock falls to $0, the person shorting the stock can buy shares for $0 and keep all the money from the original sale of the stock. Boom! By contrast, shorting a stock has an unlimited downside. For example, back in January of 2021, several prominent hedge funds shorted GameStop, GME. At the time, shares of the stock were trading at around $40 a share. But to save GameStop and thwart investment bankers, retail investors banded together to raise the price of GME. At its high, GME traded for $347.51 per share. Yikes! That means that the investors that shorted the stock could have lost as much as $307.51 per share. If the price had gone higher, they would have just lost more still. This is one popular example of shorting gone awry. It clarifies just how risky it is to bet on something with an unlimited downside. The typical investor should not consider short selling as a way to make money because it involves significant downside risk with limited upside risk. Since short selling involves asymmetric risk, the risk is difficult to evaluate using averages and standard deviations, which are the tools of conventional risk metrics. For great reading on this topic, check out Skin in the Game by Nassim Taleb. Needless to say, short selling is risky, and that is why this type of investing is typically reserved for hedge funds that are aiming to make money even when the stock market declines. It's rarely a good idea to compete against the most sophisticated investors in a game with an infinite downside. So let's take a look at some tools that you can use to practice stock shorting. Several companies have free apps that allow retail investors to practice all kinds of trading, including short selling. Think or Swim by TD Ameritrade may be the best option for aspiring traders. The app's Paper Money account allows users to practice different trading strategies, including short selling. Its Learning Center has detailed articles on how to execute the trades. Webull, a less well-known trading app, also offers free stock market simulators. Its free virtual trading platform allows users to explore different strategies and learn to profit from downside risks. Both of these tools give users clear ideas of how risky short selling can be. However, they also give users the option to upgrade to real accounts where users can put real money at risk. Webull only requires $2,000 to access its margin accounts with a 6.99% interest rate. Thinkorswim requires $2,000 and has additional requirements depending on stock prices. So you might be asking, how can I short a stock on my own? To short stocks, you must have a margin account. Most major brokerages and several investment apps allow retail investors with a certain net worth to have margin accounts. Both Thinkorswim and Webull allow certain users to trade on margin. Likewise, Robinhood and other major investment apps give users the option to trade using margin accounts. Remember, margin involves paying interest, and you can lose money. Accounts with margin may make calls, which means that investors need to deposit more money to cover potential losses. This is not something you want to do if you're short on cash. Hey, thanks so much for stopping by today. I hope that was kind of a little crash course on short selling stock that helped you think about things a little bit more. If you want to know more about this and a whole lot more trading strategies, check out thecollegeinvestor.com.